Thanks for coming. Thanks for coming. So my name's Christian. I'm with Princeton Mortgage. Actually, office with Brady over there on 126 and 2300 West. We've been in the business for, I've got a friend coming in right now. Let's wait. He's coming in right now.
Got another person to join?
Yeah.
Love it.
Anyways, we've been in business for 27, 28 years. And we do mortgages. I've been doing all that for quite some time. And
he's 29.
And I'm 29, so I've been doing this, my whole life. I'll let my friend's coming in right now. He does financial planning.
Okay, awesome.
Yeah. Raymond.
How long ago did you?
Hey, how's it going?
Kind of stuff.
Thanks for coming.
Just barely. Okay.
Have a seat at the table. We're just round tabling it tonight here. Yeah.
He was doing a lot of traveling. I need to get some.
Pulled in over there and I was like,
Retirement home.
there's no home over there.
Yeah. Thanks for coming. We never know how many we're going to get. It's anywhere from 2 to 20 people. So.
I never understand this.
Oh.
I've been to like a bunch of conferences.
Oh, really?
And then like they always have a breakout and somebody teaches and I always come away going, I don't quite
Get that reversed. This will be pretty much, this is reverse 101 tonight, so it's going to be real minor. So just introduce, because I know everyone here, Ray. I served with Ray back in the day, a long time ago in the mission field, 30 plus years ago. He was my trainer, actually.
Oh, love it.
Yeah, way back. This is Brady. He works in my office. He has the real estate side, and we share an office together. And this is Jim and Pam that are here on behalf of friend that they wanted to learn more about reverse mortgage as well. And then we have Janessa and Craig kind of running the ship back there. So so anyways, we'll just kind of get into it, but that's a little bit about me. We've been doing mortgages for 25, 26, 27 years. I'm losing track. It's been so long. But we started doing reverse mortgages probably 15, 20 years ago. Reverse mortgage is a great product. Is it for everyone? No, but the idea behind a reverse mortgage is for those individuals who understand them and it benefits them. One thing we have found over the years is that a lot of our business comes from referral and repeat business. And we find when we do a forward mortgage, a regular mortgage, that we'll get a lot of referrals from that. When it comes to reverse mortgages, we don't get a ton of referrals, and I don't know if that's because of the stigma behind a reverse mortgage. I don't know if people think that it's a negative connotation to it. We do get some referrals, but not like we see on the forward mortgages. So with that, I'm just going to jump into what a reverse mortgage is. A reverse mortgage, think of it as the opposite of a forward mortgage. On a forward mortgage, you have a payment on a loan. I'm just going to come over here just to the whiteboard real quick. And on your loan amount, let's start here. So your payment consists of, P stands for, Brady, on your payment? Principal there, yeah. Interest, I is for interest here. T is for taxes. And this is for insurance. So those are the 4 parts of your payment: principal, interest, taxes, and insurance. On a regular mortgage here, let's just say you start out and you owe $300,000. The principal amount comes over here and it comes off a little bit each month. I mean, we're talking very small. So that this is whittling down each month. It's just coming down. Your principal balance is coming down. Of your payment here, let's just say if it's $3,000, you could be having $2,000 go to interest, which goes to the bank. $500 is principal, and that's what's coming down here. Very slow, very slow. And then the other $500 would go to pay your taxes and insurance. So on a forward mortgage, the balance is coming down gradually. It's coming down. On a reverse mortgage, let's say you start with the same thing. You start with $300,000. So it's going to do the opposite. Instead of the balance going down, the balance is going to go up. And I'll explain why. So on a reverse mortgage, it's opposite of a forward mortgage. The balance is going to go up. And the reason being is you've eliminated, on a reverse mortgage, you've eliminated these two parts right here, the principal and interest. So you're not paying interest anymore. The bank's not collecting it. So because of that, your balance is going to go up a little each month. There's no principal being applied anymore. So you've eliminated those two parts of your payment. The taxes and insurance will always need to be paid, but you'll pay those on your own. So a reverse mortgage is really utilizing the equity in your home so that you don't have to make that interest payment. That interest payment then is kind of, you're utilizing it by that balance just growing a little each month. Any questions so far? You with me, Jim? So far? Yes, sir. Okay. Any questions? So with that, so a reverse mortgage is known as, it's called a HECM. It's a home equity conversion mortgage. So that's what you'll hear in the lingo all the time. It's a HECM, home equity conversion mortgage. Who's eligible for a reverse mortgage? We'll go to right here. Minimum age is 62 years of age, so it's not for everyone. You've got to be living in your home as a primary residence, so it cannot be an investment property. Second home, it's got to be your primary residence. The amount that you can borrow will depend on your age and the value of the home. The older you are, the more you're eligible for. So they actually will do, like, for example, they kind of estimate everyone will live to maybe 100 years of age. And so they'll base that, if you're 62, you're going to live to 100. That's a lot of years to live. So the amount you're going to be eligible for is going to be pretty small. But if you're 90, you don't have much time to live. So they're going to give you a lot more as opposed to being 62. Because what's happening is, on that chart there, that interest is growing each month, is growing. And so when you no longer are living on the earth and you've graduated to the other side, the bank wants their money. So they want to know that they're going to get all of their money back, because now you're not making a payment on it. That interest is just growing each month. So if we start with, do you have a mortgage on your home right now? What's the balance? 63,000. So tell me what the home is worth approximately.
Well, it depends on who you're going to ask.
Yeah.
If I ask Justin, I get one price. If I ask, he's pretty good with what he says. But taxes is like
600,000. Okay. So
Yeah.
600,000.
Yeah.
Okay.
That's your tax value.
That's your tax value. So we'll use that. That's conservative. So we'll figure maybe 700,000, but we'll.
Yeah. See, Justin says don't go by that.
Yeah.
No, that's low with everybody, kind of across the board, for sure.
He says it gives you an idea, but it isn't really. He says I guarantee you, and then he goes like this. I can do this.
Mm-hmm.
Starts going down that.
Okay. So you owe $63,000. And over here, we're just going to put 700,000 is what it's worth. Pam, I'm assuming you're the younger of the two? Some days. Do you mind telling me your age?
You want to know my age?
Is that really? I never would have guessed. Okay.
I said it quietly first, just to see if I got any response. And I did. Back there, but that was about it.
So my guess is on your age, because they'll go off the younger of the two, because they figure you're going to outlive.
How old you are, Jim, is what he said.
They figure that you're going to outlive Jim because of your age. So they go off of your age. off of your age, I'm just going to guess approximately, you would be eligible to, if your home was at $700,000, you would be eligible for approximately 40% of that. Meaning, so that's $280,000 that you would be able to access this $280,000 here. So of that $280,000, because you have a mortgage, that would have to be paid off. So you'd have $280,000 less $63,000, which comes to $217,000 less any cost. And just for rounding sakes, I'm just going to put $17,000 here, just so we can go down. So that would leave you with $200,000 left over that you can use at your disposal, however you want.
And it's not taxed.
It's not taxable. That's correct. It's not taxable. So, Janessa.
So do you just get like a check for $200,000, or does it come to you each month, or like how?
Okay, that's a great question. So you could set this up. There's a couple ways. First of all, in year one, you're only eligible to get 60% of whatever this is here. So if you wanted to take a lump sum, 60% would be $120,000. That would be your lump sum if you wanted. You don't have to take any of this right now. You could leave it all there. I'm assuming on your payment here, $63,000. How long have you had your loan for?
This one, because we just refinanced it. So we've got like, I don't know, 5 years, so it was on a 10.
Oh, it was on a 10-year loan. So my guess is you're what, $1,000 for your payment? Does that include taxes and insurance?
173.
Is part of that?
$1,073.
Is your total payment? Oh, that's pretty close. So $1,073, but that includes taxes and insurance, which my guess is probably $300 or so.
Oh, escrow's in there too. Is that what you?
Yes,
Yeah.
So 300 roughly. So by doing a reverse mortgage, you guys would eliminate roughly $700 of monthly expenses. So you'd eliminate that. You'd still be responsible for your escrows. So this is where you guys need to ask yourself, well, what's the trade-off? So you would save $700 here. You've paid off your mortgage. You're eligible to get roughly $200,000. The question is, how do you want to use that now? You can take a monthly, in answer to Janessa's question, you could set it up to take a monthly amount. If you wanted to take maybe $1,000 a month just to add to your income. You could take the lump sum of this up front, and then in year two, you could take out the balance of $80,000.
And when?
Year two,
Yeah, just all of it?
all of it.
So within 2 years, you can clear the entire 200.
Correct,
Tax-free.
correct. My parents did, my father passed away 14 years ago, and just within a year after that, and her home was free and clear. We did a reverse mortgage, and to this day, she still has a zero balance on it, but we set it up just for a rainy day. In case she ever needed it for whether medical or anything, we just set it up. But there's no balance on it, so nothing is adding.
She never took money out?
She
or
never-
Never taken a draw?
Never taken a draw. And every year I keep hearing how she needs new carpet or she wants a car. I'm like, go take it out. I mean, it's your equity. It's your money. You can do with it with what you want.
Expire, or can it just sit there?
It just sits there. Yeah, it sits there.
Once it's open, it doesn't go away.
It doesn't go away. That's correct. It is a line of credit. So if you don't take anything, let's just say, if you don't take anything in year one, this line of credit, you say, I don't want anything, that line of credit does increase a little bit each month, each year. So you start out with $200,000. After year one, you may have maybe I'm just estimating, maybe $205 on a line of credit if you don't use anything. So that grows a little each month. So those are the options. Now keep in mind, if you decide You want to pull out the whole thing. You started over here with 280. So now each month that balance is going up a little each month. So you may be tacking on, I'm just guessing here, 2,000. Each month you may be tacking on $2,000 in interest. So that balance is going up considerably. What we have found is when we do reverse mortgages, if there's a husband and wife, we always will sit down with them, and they're always great in talking and saying, no, this is what we want, this will work for us. If there's just one parent involved, I always bring the children in, because the children are more concerned about their inheritance or what they're going to lose, and they're worried about what I'm giving up. And so we want to make sure they are aware of everything going on here, because at the end of the day, for example, my in-laws, my father-in-law passed away 2 years ago. My mother-in-law passed away 4 months ago, and they were on a reverse mortgage. And for them, it was a huge blessing, because they had a huge balance. We did it probably 12, 13 years ago, and I think they owed at the time like $240. As you get older, you'll notice that expenses never seem to go down. They just go up with medical and everything, the cost of living, but the income seems to be fixed. And you've probably noticed that with your clients, right? And so my in-laws owed about $240. They had some other debt that they paid off. And so I think we did a loan several years ago at $300,000. And they've been in that home for 65 years. They weren't going anywhere. They built the house, didn't want to go anywhere. But it paid everything off. This payment was almost $2,000. So it really saved them some money, because they eliminated a house payment, eliminated a car payment, and some other things. Well, that $300,000, so we're getting ready to sell. I think this week we close. I think now they owe it's $510,000. But in the meantime, they've been able to stay in their house. They haven't had to worry about going anywhere. That interest has accrued. Luckily for my wife and siblings, they're going to sell for more than this, and then they'll be able to pocket the difference. So that's the downside with the reverse mortgage. So as you talk about a reverse mortgage, you need to ask yourself, well, what's the benefits to me? Am I just saving the house payment? Am I putting cash in my pocket? And what am I going to do with that? Is it going to help my living expenses? You may find that you don't need to do any of that, that you're doing just fine. But you do have equity in your house right now of approximately $280,000 that you could use to however you want. And I think you asked, or Janessa, that money is tax-free. I mean, it's your equity. You're just pulling that equity out now.
So if you pull it out, the government doesn't get it either, right?
That's correct.
They don't.
That's correct.
So with that 510 right there that you were talking about, is that what they had to pay at the end out of the sale of the house?
Yes.
Because
Because the interest, so they started with a loan amount of $300,000. And remember, we did this, I mean, it's been at least 10 to 12 years. So you've had interest accruing each month. It's been tacking on $2,500 a month or so. I mean, it's been tacking on. So it's just, the balance just keeps getting bigger and bigger each month. So for my wife, I told her when her mom passed away 4 months ago, I said, well, I don't know what you're going to do, but if you're going to sell, I would sell as fast as you can, because you're losing about $2,500 a month in interest right now. And so that adds up. I mean, they're going to pocket a little bit, but that balance goes up every month because of that interest.
So say there's, I don't know how many siblings there are, but just say there's like 4 siblings, and that 510 is what you have to pay off, and you sell the home for $700. It's just that difference.
That is correct. Yep.
Is what's going to be divided between the 4.
Yep, there's 3 siblings, and I think they're locked in at $750. Less is our real estate fees and that. That's right. They're going to pocket the balance. That's exactly right.
Real estate fees is what? About $30,000 on that?
What were we? We were about 3% roughly, so 21,000.
So about 15, 20,
21,000, yeah.
21,000 off that the realtors
Mm-hmm.
I think it's important to bring up, though, that they owe that 510 after 12 years from having that. In 12 years, how much has the house appreciated as well?
Depreciated.
Appreciated. How much has it gone up in value in the 12 years since they did it?
That's correct, because when we first did it on this loan of $300,000, I want to say their value at the time was maybe $450. So that's
Right,
gone up.
together in scenario 1 and 2. So if they owed 300 at the time and it was worth 450,
They had 100.
scenario number 2 is they owe 510 and now it's 750. They actually were able to get that tax-free money up front, and they actually never lost any.
They never lost any money, and they were able to stay in their house. I mean, she was 90. She was 90. My father-in-law was 92 when they passed away. So they lived there since they were, no payment, and got to stay in their house that they built, in 1955 or 1960, whenever it was.
I was gonna say, my mom has a reverse mortgage, and she's spending a little bit from it, but I want her to spend every penny.
Absolutely.
I want her to be negative, and she'll enjoy every dollar.
Absolutely.
I don't want any of the money.
Yeah, and that, you know what? That's that's exactly what we say, and we do that with my mom. Like, if you need something, use the equity. It's for you. It's your house. You're exactly right. And that's the other benefit. So she uses a little bit each month just to live off, or use it for her benefit. So it's entirely up to you how you want to use that money.
She set it up that way, or she has that option to do whatever she wants to with
She can do whatever she wants. She can set it up to get a monthly withdrawal. She can set it up to just take a lump sum. It's however she wants to do it.
She can just set it up to just use it when she wants to use it because it's there. to
Correct.
use.
That's exactly right. In fact, I had
What your mom is doing, she never.
She hasn't. My mom hasn't used it. Your mom has. I had a client call last week, and she took out the lump sum. So she took whatever she could in year 1, and she wanted to get the balance in year 2 here. So she called me last week and said, "Can you get me the information so I can call?" And they just wired it into her account.
So is it similar to a HELOC? So you get approved for the 300,000 and you don't actually pay any interest on it until you start using it?
Until you start using it. That's correct.
Recommend, unless you have a real need to pull out that lump sum, hold off.
And I mean, it's your money. You can do what you want. You're right. But as soon as you start drawing on that money, interest starts accruing. So for my mom right now, her balance is this. She hasn't taken anything. And every year, new carpet. I want a new carpet. Well, go get it, Mom. She keeps kicking the can down the road. So, but as soon as she draws on that, then the interest will start accruing.
What's the interest rate on these?
So that's another great question. So let's talk about that here for a second, because there's different program or different loan products that will benefit.
Before you go forward, may I just stop the train of thought for just a
Yep.
moment? Okay, so you said she has a 0.
Yep,
And she hasn't taken anything out at all, so she has not had any interest whatsoever accruing at all. Is that correct?
that's correct.
So if she decides, so she has to sell the house, she passes away, she has to sell the home, she's not gonna have any interest lost out of that she has to pay back.
That's correct.
Because she's kept it at a 0.
That's
So
correct.
if she even takes $1 out, then the interest is.
That is correct.
So if she does absolutely nothing with it, like buy her new carpet or whatever she wants to do, she's good and golden with nothing, no being taxed, no interest.
That's correct.
Unless she takes the first.
Say that again.
Is the interest just on the $1? Is it based on the amount that she's pulled out?
On the amount she pulls out.
Okay.
Yeah. Yeah, it's on the amount she pulls out. So if she pulls out, if she wants $20,000 to redo the house or model or whatever it is, interest starts accruing on $20,000. She may have a line of credit right now. I don't know what her line is. It might be $200,000 when we did it. It's been so long. But she's only going to pay on what she pulls out.
And she's not going to pay it. It's just the interest.
Excuse me, that's correct. She's not paying it. The interest is just accruing on that. So if my mom lives another 10 years and she only pulls out $20,000, she may owe $28,000 or something like that. That's right. Yeah. And at least we're in the same boat as Ray. Like, I want my mom to use, if she wants it, use it. Like, I don't want to, I'm not worried at the end of the day, like, what we sell the house for or what goes in our pocket. To me, I'm more concerned about her using her equity, all of that. But I can tell you that in my 20 plus years of experience with this, that when there's one parent, for whatever reason, all the children are very, very concerned about what they're going to get when that parent dies. And so I always bring them in so they're aware of this is what's happening. You know, your mom wants to do reverse mortgage. This is what the numbers look like, so you know what to expect. I had one 2 years ago, and I was on a Zoom call with eight children. And I thought, oh, and you know what happened? They didn't do it. Yep, 8 children, because they're counting their dollars. Yep.
But that's because you've said before, and correct me if I'm wrong, that the parents are typically worried more about what they're leaving their kids than using what they've earned in their life. That is kind of the...
Yep, so true.
People die with millions of dollars dug in their backyard to not leave something to their kids, right? Like
That's
how a lot of
exactly
people
right.
live.
Yep. So I get the children on one side that are concerned what they're going to pocket, and the parents are concerned what they want to leave for their children. That's right. Yeah. Yeah.
Have you ever seen, I guess maybe it would take like a really big shift in the market, but have you ever seen that the interest exceeds like the value of the home, or is the way they set it up?
I haven't. Okay, that's a good question. So let's talk about that real quick. Because let's say, and do you guys have children?
We do, and that's what I says, I wish I had sons like you. Oh, I have 4 boys.
Okay.
And I should have had my youngest come here tonight because he's the one that is kind of gonna be over everything. I have 2 of them that are, let me put this.
There right now, we use the 280. And you decide to pull out, just for argument's sake, you pull out the whole amount within a couple years here. So we start accruing interest. And let's say that you both live 15, 20 years, and at the end of the day, we're up to $500,000 is what is owed. When you two have graduated to the other side, we have $500,000 that's owed. And for whatever reason, the market now, for whatever reason, your house is now only worth $400,000. We've had some big major economic thing, and you're at $400,000.
Zombies.
Yeah. So this is to answer your question. Like if your interest doesn't. So you owe this, your home is worth this. The bank does not go after you or anything for that deficit here, because the bank wants to get their $500,000 right off the bat. So what happens is the most popular reverse mortgage is through FHA, Federal Housing Administration, government loan. On every reverse mortgage, there's what is called is mortgage insurance. And it is pricey for a reverse mortgage. It's 2% of the appraised value. So of the appraised value, if we had on our scenario was $700,000, part of your closing cost, your upfront mortgage insurance is $14,000. So reverse mortgages are not cheap just because that's just one portion of the cost. So what happens is that the mortgage insurance kicks in, because if they can only sell the house for $400,000, the bank's short $100,000, because this is what's owed, the mortgage insurance kicks in and pays off the bank the full $500,000. So the bank will always get their money, always get their money. Your children may not get anything, depending on what the market's doing, but the bank will always, they are protected right from the get-go.
But they're also protecting you by only loaning you 40% of the value, so they're
That's correct.
double protected.
They're double protected, that's right. They're padding their pockets because they're not giving you all of the equity up front, knowing you're going to live so many years. And then they're also protecting themselves by this mortgage insurance.
And you have to do the mortgage.
You have to. There is no ifs, ands, or buts. That's
Through the loan.
uh-huh.
That is-
It's all rolled in. It's all rolled in. So correct.
It's not something you pay out of pocket.
That's correct. It's all rolled in. So nothing out of pocket. That's correct. So those are great questions. Part of the reverse mortgage counseling or reverse mortgage is doing counseling too. Like you have to get counseling for whatever reason. The government thinks that you guys, the seniors, need to be counseled on what a reverse mortgage is and all of that. So you get counseling, and they go through to make sure that you're aware of what you're getting yourself involved with. And that counseling has to be done. It's good for 6 months, and it's easy. You just do it on the phone. You call in. They ask you a few questions. I give you some paperwork that they have access to, and they just ask you a few questions. But it's easy.
They're trying to make sure you're not being taken advantage of.
Correct. That's correct.
Slickster hasn't called.
That's correct. Now back to I think Janessa's question on what the rates are on this. So on that 280 here, we talked about, you can get the most popular mortgage in Utah, and I think throughout the country. The U.S. is a little different than other countries, but the most popular mortgage on a forward mortgage is fixed. Hands down, it's a fixed rate. And for everyone, the majority, 30-year. You guys did a 10-year. I wish everyone could afford a 10-year or a 15 years just because you build so much equity, you pay down the principal. But the 90% of people do a 30-year just because that's what they can afford. On a reverse mortgage, you've got a fixed product. You've got an adjustable product that adjusts monthly. The fixed product usually gives you'll get more money on this product right here. And it tends to be sometimes substantial, anywhere from $5,000 to $20,000 more under the adjustable. The fix, you can do a fix, but again, you don't get as much money on that. And people, like I said, this is the popular product for forward mortgages. But over here, 99% of the people do this one, just because you have access to more equity. And at the end of the day, when people say, well, when you're gone, who cares what your balance is, right? I mean, who cares? Because you're not here, so why not maximize what you can put in your pocket right here? So those are the two. You can do a fixed or an adjustable. And on the adjustable, it's like a home equity. There's an index plus a margin. The indexed is fixed, so it'd be like the prime rate, that's not fixed. The prime rate adjusts. The margin is fixed. So the prime rate right now is 8.5. The margin, let's go 1.25. So on a home equity line of credit, you could be paying 9.75. I think those are the numbers I gave you, roughly, wasn't I, on the home equity? Yeah. So the index, this will vary. This could go up or down. This is fixed. And that's how the adjustable is as well here. You're looking on rates on a reverse mortgage similar to fixed now. You're in the mid-7s roughly. For
It's adjustable and rates go to 5.5%. What does that do?
So that's a great question. So what you find right now, when I throw out that number of 40% of what you're eligible for, a lot of that's based on the rates right now. So if rates went to 5.5%, you might be eligible for 46%. So, for example, my mother-in-law, who just passed away, we did their loan originally back, it's at least 12 years ago. And when we did that loan, their rate was higher. The value, though, was roughly about that $450. Well, when my father-in-law passed away 2 years ago, we talked to her about if she wanted to redo it, to pull some equity out, to use some cash. The rates were a little lower, so she pulled out an additional $60,000 and kind of reset that again. So she was able, the values went up. She was able to pull out some more equity over those years because the value had gone up. And the rate had actually gone down a little from when she first did it.
So if the rate goes down by 2 points, 2 percentage points, and you get an extra $60,000 access to funds, is that 2 years again to get to that $60,000? Is that how that works?
What do you mean 2 years to get to that?
If your margin opens $60,000 more because the rates come down in your credit line, you said the credit line will go up?
The credit line will go up a little bit each month, correct?
If it goes down substantially, from the time you open it at 7.5, or let's say 7.5, and maybe in a year it's at 5.5, you now have $60,000.
Oh, does that line have been
available.
credits? The line of credit will just increase. Yeah, that increases based on the rate. So I can't give you exact on that.
Would it be tens of thousands of dollars?
I would advise on something like that to even refinance, because chances are you could open that line of credit even larger. Yeah, you're gonna.
Because the rates coming down would open it a lot, and that would.
Correct, because that 40% I'm throwing out, that's based on rates today. So if rates were at 4 or 5%, you might be closer to 47, 48% of that appraised value. And it's also,
Which is a big deal.
which is
The
a big
rates are the highest
deal.
they've been in.
I can tell you that most people that call me on a reverse mortgage right now, 9 out of 10 we cannot help because their mortgage is too high and they don't have enough equity because they're only getting that 40%. I've talked to some, we're getting 35% because they're at like 62.
They're younger.
They're younger, yeah, and they're leveraged so high on their mortgage, we just don't have enough equity. Because that's what the bank's looking for is, they're going to win no matter what. They want this much equity at the end of the day because it's going to grow a little each month. Yeah.
Hey, Chris, tell us about the line of credit portion. So, like your mom, she never used it, which means her line of credit is a growing number.
It's a growing number, the line of credit available. That's correct.
So, because I'm looking at these going, all right, if I have a client who is in 10 years going to run out of money, maybe they want to go get a home equity line, go get a reverse mortgage now, so that when they're declining years right at the end.
Yeah, then they could
can
start
tap
tapping into
into
it. That's a great idea.
But when they're not, they might not be able to set it up at that time because they might not be, as lucid as they would need
Sure.
to go through the whole process.
Sure. And so
It'd just be a growing.
it'd just be a growing, exactly, you're exactly right. It grows a little bit each month, that line of credit. And again, until they start tapping it, no interest is accrued on it. Yeah. Yeah.
That's smart that you did that for your family, because it's just open in cases.
We did it just for emergency stuff, in case there was a medical emergency, or if she wanted to use the equity, like for whatever she wants to do. That's exactly right. And we did it at a time too, when we did it, because they keep tightening up reverse mortgages all the time. We did it at the time too, where she was eligible for this much, where if we would have done it now, it'd probably be like this much, even though there's nothing owed on the house. So that's right. Yeah, constantly changing.
So even though obviously the market isn't fantastic right now, it could be a benefit to open one now, do the fixed rate, and even if you're just sitting on
Keep in mind, the fixed rate is only if you're going to take out a lump sum.
Oh, okay.
Yeah, if you don't take anything out, you're locked into the adjustable, because the fixed rate's going to start ticking when you take out that lump sum. Yeah, yeah, correct. Again, I would not advise on this. Everyone's always fixated on a fixed rate just because that's what we're used to. But on a reverse, you're going to maximize your benefits on an adjustable.
So even though the market's not great right now, there really isn't a downside in theory.
No. To me, in a reverse mortgage, it's all, there's no right or wrong. What's best for the consumer? What's best for the individual? Are you lacking cash flow? A lot of people will lack just because their income's fixed. They're stuck on Social Security and maybe a small pension, but they have all this equity in their house. Could they start tapping in to take maybe an extra $1,000 or $1,500 a month to help? And if you don't need that, maybe you don't need to, but that is your equity when it's all said and done. When you're on the other side, if you didn't use it, it's going to your heirs, right?
So, and it's fair to estimate, I think, that if you look at this product is really a 10 plus year potentially product, not like a 3-year product, I guess, in my head, because you could use it if you all wanted it to, but for you to really get it for free, tax-free, and have access to all those funds, over 5, 7 to 10 years, whatever you pulled out, you're going to end up making back on appreciation in my mind.
Yes, correct. Yeah, I think the only thing you need to look at, and this would be something, Ray, for like your client you're talking about, is
meaning if you have insecurities for your kids, or they're feeling insecurity that they're not going to get as much, the appreciation, like in your model with your in-laws, was it appreciated so much over the 15 or 20 years since they had done it that your family is still getting an
they're still,
inheritance.
absolutely,
It's not
absolutely.
zero. They're still getting a lump sum.
They're still getting something.
But in the meantime, it provided a huge amount of relief for the parents.
And not only huge relief,
It was a
but
win-win.
they also had money to cover expenses, which they would not have had they had
They
their
would have had to have done that.
had they had their mortgage payment and an auto payment and all those things. They wouldn't have. Then we would have been helping them out.
Yep.
Then we would have been putting money in. So for this, it was a win-win. And as much as we still did help out, at least it eliminated the big payments, and they were able to stay in their house and right to the end, and they loved it. What was I going to share with you on the? You asked something just before that.
You said something over here.
Oh, I did. I mean, I had another question about that home equity line growing.
Oh, I know.
It's based on interest rates.
Yeah.
So if rates are higher, doesn't that benefit me if I'm just saying I want it to be a growing credit line?
Yeah, correctly, because it'll grow. That's exactly right. It'll just continue to grow a little each month, that line of credit. That's what I was coming to, the cost-wise. So maybe this is where you want to look to see what's the cost benefit. You're looking at right off the bat 2% for mortgage insurance. So on $500,000 appraised value, that's $10,000 in mortgage insurance. And then you'll have your other title fees and appraisal fees. I mean, you could be into it another $5,000. So $15,000 just to set up a line of credit. But you are setting that up with the ability that it's there, all of that. With something like that too, I'm thinking of your client, maybe it'd be beneficial if they set up just a regular home equity line of credit too, but then again, they're going to be responsible in making that payment. But you can set up a regular home equity line of credit for zero. Maybe a minimal of that. I mean, that could get kind of pricey.
Well, and per the appreciation, I mean, that 15,000, that break-even point shouldn't be that far out.
No, you're exactly right. The appreciation should wipe that out.
That's my conversation with, kids like yours or any other kids, 99% of families where kids think that. You have to understand that this is the relief for mom and dad immediately, and honestly, you're not gonna be giving up anything. With this model of 40% at a max of what you can borrow, it's like you're already gonna have what's left over from that, and then if it needs to appreciate whatever X amount of dollars over 10 to 15 years, I see in the model like your in-laws, like I don't see how it's a loss.
No, and it wasn't for us. It wasn't, yeah.
I don't see how your kids get less in 15 years while you get everything for free in the meantime, if that's a model you want to look at. That's what I would talk to kids about. I had this conversation with my parents, and my parents in their brain think that they're going to be giving their kids less, so they're insecure about doing it because they're like, we want to leave them something. And I say, I try to do it as best as I can. I said, you are going to leave them something. That won't change. Even though your balance is going up, I'm a real estate person, so I do understand this a little better than most. You have to understand that even though your balance is going up, your house value is going up as well. and that's usually in parallel.
That's correct.
Right? So I have to help my parents understand and know that you're not taking anything away from them. You're just really creating a much more secure lifestyle for you.
For you, because the same amounts, it's like a tide rising.
Yeah.
That's correct.
And my siblings don't need to want the money either. It's an insecurity from my parents, and I get that they want to leave something, which is fine, but helping them appreciate and understand the numbers of you get all of this now and still are able to leave something for
Correct.
your family.
That's right.
You ask yourself the dollar amount leaving. What is that really worth? You know, I mean, is it worth
You're right.
$1,000? Is it worth $1 million? I mean, what is that really worth considering if they're taken care of and you or who the children don't have to worry about that part of it coming out of their pockets? Am I right?
Yeah, that's exactly right,
So
because
that's where I think that is that I don't want to leave my children with debt. Like, oh my gosh, now I have.
Your debt or their debt?
My debt. I don't want to leave them with my debt.
Your trust.
Yes.
Debt or your personal debt?
Personal debt.
Like what specific?
I don't know.
Okay.
Just
Just anything.
anything. Just anything. I mean, for example, burial. You know, I mean, you don't want to sit there and say, okay, well, oh my gosh, what are we going to do?
Yeah.
Da-da-da-da-da. I don't want to do that. I have an issue with that.
I can tell you, when we refinanced my mother-in-law 2 years ago, after my father-in-law passed, she pulled out a chunk and she was prepaying all of her stuff for burial and all that. Everything was done. Yeah.
That's
Yeah.
interesting.
She didn't want us to worry about any of that.
Did she need some for end of life?
No, not really.
Not from that.
Not from that. No, she used it and she wanted to give back to us. She started buying us burial plots. And it was stuff that we're like, we don't want them. Just spend it on you. Like, seriously, this is your money. Like, use it for you. But she also got to an age, she was a month before her 90th birthday, so she was 89. But, I mean, she was barely getting around. So for her to really say, I can use this money, her way of using it was trying to share with others, because she was at a lifestyle now where she was barely moving. So, you know, to me, she almost waited too long to enjoy some of that.
So if it happened to end at that particular scenario, and would she, just say for example, she's incoherent and she can't really make choices anymore. Is that where the trust comes in?
Correct. You will, when Carson would have filled out paperwork with you, there should have been a form in there that talked.
got that
Oh, you haven't got that far. There will be some there will be some documentation that talks about end of life type stuff and living will, all that kind of stuff. Who can make decisions when you're not capable? So that will be in the paperwork that you're doing with Carson. Yeah,
You can assign someone to tap this to make your end of life.
that's correct.
payments.
Yep.
Say that again?
You can assign somebody to tap your home equity line of credit, so your reverse mortgage, to pay your nursing home costs,
Okay,
if it was needed.
okay.
Yeah, on a reverse mortgage, so anytime you do one too, they always ask for next of kin, so they can kind of keep in touch. One of the things that, like my mother-in-law who's getting up in age, she kept getting something in the mail and I wasn't aware of, but they send something every year, just making sure you're still in the house, you haven't passed on, and that you're living. And she kept ignoring it, and finally I found out, and I'm like, oh, you got to send this in. They think, you know, because as soon as they know you're passed away, they're sending stuff immediately because they want to get their money back because now it's their payday, really. So
So when you pass, what happens at that point?
So when she passed, and their technology nowadays is amazing because they have so many tools that I think they're checking constantly. I was going to notify the reverse mortgage company and say, hey, my mother-in-law's passed away, FYI. They had already found out. They had already sent out a package, and this was like within probably a week, as soon as they saw the obit or wherever. I think they're constantly checking. So they sent out a package immediately just saying, what's the plan? What are you doing? Fill out this information here so we know who we can contact, etc.
I think that's the other misnomer, though, is a lot of older people think that now the bank owns their house.
That is one of the myths, and so let's talk about that real quick. So when I talked at the beginning, kind of a stigma, I think, of doing a reverse mortgage. I think it's getting less and less as people get educated. But I think for a period of time when people did a reverse mortgage, it was really looked down upon. People think that, oh, I turned my house over to the bank. I don't own my house anymore. That is not the case. You own your house just like you do on a regular mortgage. Title stays in your name. Everything is in your name. The loan itself is just to a different bank that now where the interest is, instead of principals paying down the balance, the interest is adding to it, so it's going up. But everything is in your name. So that's one of the biggest myths, is that you do a reverse mortgage. Yeah,
Most homes.
a lot of equity. Nowadays, a lot of equity. But that's the biggest myth, is you do a reverse mortgage, I just turn it over to the bank.
Yeah.
And that's not the
So the bank
case.
was asking you, what's the plan to sell?
What's the plan? Yeah, you planning to sell it?
Planning to sell it.
Yep. And as long as you keep in touch with them, communicate, all of that, they're great. Again, they won't lose because of that mortgage insurance. They're going to get their money, but they do want to know that things are in process.
It's beneficial at that time for the kids to sell the house because, like you said in your scenario, it's accruing money, and mom and dad aren't there anymore, so it is beneficial for us to sell it sooner rather than later.
Sooner than later, yes. Janessa?
I wanted to share something that I had just barely discovered like a month ago, that kind of all the end of life coordinating pieces that I desperately wish I would have had. It's called, I know there's probably a million and one different companies, but it's called Full Circle, and they work alongside your trustee, but they do all of the communication. They'll cancel your cable and your phone bills, and they'll reach out and coordinate with, they basically do all of that stuff instead of, for like me and my siblings, we're going through my mom's mail to try and,
Yep.
you know what I mean?
That'd be good to know, yeah.
It's an absolute nightmare, and I just had no idea like those types of services existed. And so now when people do their end of life planning, they do like whoever their trustee is, but in addition to like a service like this that can kind of help manage all of that, which I thought was just a godsend. It's so
That's huge, especially because the trustee of my mother-in-law was my brother-in-law who lives out of state. And so mail's being forwarded to him. I don't know what's being paid. It's just, it's a mess, yeah.
They do all of that, like,
Yeah.
literally from phone bills to, yeah, it's closing down bank accounts is really cool.
Yeah, that is good to know. So that is the biggest myth, though. We turn the house over to the bank. That is not the case. It is your house. It'll always be your house. Titles, yep, it's titles in your name. Nothing changes there.
So if I had, just say that Jim's not here anymore and I'm wherever I am in life and I need to go to a care center, but yeah, my house is there. Does this?
They want you to be occupying that house.
I can't occupy it, that's where I'm going. If I cannot occupy it, then what happens at that point?
So that's kind of one of those gray areas because they do want you to be occupying it, but you're in a care center. So that's where your trustee or someone would be communicating, saying, "Mom's in a care center. We're trying to sell the house." You know, at that point, if they know you're in a care center, they could maybe freeze your line of what's available, depending on you know, the situation and stuff.
If you're going away and not coming back.
Correct.
If it's like she's going for 2 months or something.
I wouldn't even say
we
anything.
have,
Absolutely.
You know,
Yeah.
if the plan is I'm moving out and not coming home, that changes a little bit.
That changes the scenario.
Then
Yeah.
you could just sell.
Then you can just sell anyways. You'd probably want to sell at that point. If you knew you were not coming home, you're right. Sell, pay off whatever's owed, and then you're going to use the other funds to provide for you at the care center.
So that answered my question. Now I understand something that happened. I'll just give you a quick synopsis because it's too lengthy. So
helpful? Is it to take a lump sum? Like, I'm curious what that conversation would sound like with them and you right now, like if you were having that.
And again, it's gonna be personal preference on that one, because I don't know your situation. I don't know your income. I don't know your debt. I don't know what your things are. So depending on, I mean, you can.
I'm assuming for Carson to have brought it up, and you can have a one-on-one with Christian too, but I'm just curious that there was something there that he was like,
Yeah, I don't know. So you're going to be looking at maybe an increase of monthly cash flow. That's going to be benefit one.
because instead of paying in, it's now coming back.
That's correct. The other two would be you're going to eliminate your mortgage payment. So you're going to increase cash flow twofold. And so maybe this is just the first one you're looking at is, hey, let's put an extra $700 in your pocket by just eliminating your mortgage. Don't take anything else out right now, just eliminate your mortgage. You will have access to those other funds if you want. To me, those are the number one reasons why you want to do something. Is, you're just eliminate debt or increase cash flow. That's the bottom line of why you want to do it. Other than that, I mean, I can't really think of anything why you would want to do it.
$700 is 10% of your income or 20% of your income, and you have no other debts, and you have enough money coming in, then not really a reason to do
Yeah, correct.
just pay off the house on the 10-year and keep it going.
Yeah, you did it a few years ago. You got, what, 7 years left, and the loan's paid off. But if that payment's hurting you, and you've maybe got some other issues that, whether it's medical and stuff like that, that could be something you can eliminate and also put some cash in your
Or
pocket.
if you don't have cash set aside for future potential medical expenses, like you did with your mom,
Just set up a line.
open the line and have that available so you know if he has to go somewhere, then, that's how we're paying for this now.
Yeah.
Correct.
Long-term care.
Long-term care, something like that, to where you're not tapping into maybe other 401k or anything like that. That's correct. Because you're using the equity and it's tax-free. You pull out 401k, you're going to be, taxed on it. Even though you're of age, you're going to start getting taxed on that. That's correct. So you could almost be looking at that as tax-free money just to have it there in case you ever needed it.
I think he was trying to set us up too as such that we have some other investments and he was considering taking it from there, paying off the mortgage and starting with a zero on a reverse. Is that possible?
Yeah, didn't you just mean like a line of credit? So you pay off the mortgage with investments and then you just have that line of credit like in my mom's situation. So you just set up a reverse and it's just there.
That's what I believe it was really a lot of information.
Yeah.
When we sat with him for that 1 hour, I mean, it was a lot. And I'm just, oh, geez. We're going to be having several conversations and I thought, yeah, probably.
But simplified, if you've got it in other assets and you're going to pay that off, it's not costing you anything. You're just kind of moving the money around.
Yeah.
Yeah, because you're just taking the $63 from another investment, putting it into this, and you already have that extra 63 in a credit line, so it's available tomorrow. So it's not like you lost it.
Yeah.
But as I've been thinking about this, and my one son cautioned me, he says, and this is really funny, I'm just going to tell you, he says, the first thought that comes into your mind is God. Anything after that is the adversary. So just remember that, Mom, and you're going to be fine. And so whether, I don't know, his flaw, if you met him, you would know. He said that is exactly him 100%.
He's something else. Is that what?
But I don't want, as I've been thinking about this, I don't think I want to pull it out of the investment to pay off the house.
May not be necessary.
Is what I don't think I want to. I don't know if that is a right thing or a wrong thing,
Yeah.
but I am kind of thinking, I mean, because it's his pension money that he got. And so I'm just kind of thinking, just leave it there, let it do its thing. Because I'm not going to be penalized one way or the other because it's there. It's just there and it's just going to keep doing whatever the market's doing and whatever else
Sure.
is happening to it. Either I'm going to get or I'm going to lose, one or the other. And just leave it there because I can get it anytime I need to. I mean, am I right
But
with
I
that?
can't, so that, I mean.
Isn't that right with that? Well, I guess maybe it depends on the way it's set up, but my understanding, if I needed to pull money out of that, I could, because, I mean, I can.
And to me, the big question is going to be is the $700 hurting you each month right now, your mortgage payment?
Not right now.
If it's not hurting you right now, maybe the urgency's not right now, but maybe we revisit each year to kind of see where things are at and what it looks like. Because your home's going to be paid off in 6, 7 years?
Well, yeah, I would think.
5 years? If you did a 10-year loan, how many years ago did you do it?
I don't know what year it was, but we only.
Probably 4 years ago, 3 to 4 years ago.
You just said 4 or 5 years ago on a 10-year.
So you got 5 years left. So if the payment's not hurting you and your cash flow's okay, this is me, his financial planner, he can give his advice. I would just kind of keep as is, and we can look at setting something up in the next couple years. Yeah, I mean, if it's not hurting you and cash flow, you're okay. But it's up to you. I mean, there's no right or wrong. What would you say?
I was gonna say, it's probably sixes, except for you could look at the reverse mortgage as a long-term care policy. So
I
right
think
now,
that's
if you
where
bought,
Carson was
if you bought long-term care, it costs you about $5,000 a year, probably more at 70, might be 10,000 a year. So essentially, you could get a reverse mortgage, get rid of your payment. Granted, you're out to 15,000 in closing costs, but
But you make that up the first year in the
In the-
$700 savings a month.
Yeah, that's right.
and then you just don't
That's
tap
where
it,
the
and then when
plan
you
is
have
going.
end-of-life stuff, it's all available, and
Tax-free to
yeah,
pay.
and you don't have to worry if if you've depleted other assets, you always could just tap into that.
Yeah. So, I mean, there's some great options either way.
If it was all based around end-of-life care, I can see, like, where you were having the
I
conversation.
guarantee you it was, because he started asking some questions and that, and it was really funny. I mean, it was kind of like the first couple of questions that came right out of his whole. Come to this because he wanted us to understand what he was saying, because he's the one that brought this up.
Well,